first off, I want to welcome everyone to today's webinar. Obviously this is organized by the E-Access Forum, and we've really been able to enjoy this sort of young scholars setting and have a lot of good presenters. Today will certainly not be an exception. We're very happy to have Yasmine van der Straten. She's going to be presenting her work on funding the fittest, pricing climate transition risk in the corporate bond market. So I'll just give a little introduction before I turn the time over to Yasmine. She's a PhD candidate in finance at the University of Amsterdam and is joining the Nova School of Business and Economics as an assistant professor in September of 2025. So first off, congrats, that's awesome. Her research lies at the intersection of macro finance, climate finance, and household finance, and combines theory and empirics to study how climate risk is priced in financial markets and how financing frictions and price signals shape adaptation, mitigation, and political support for climate policies. She's a visiting PhD student at the De Nederlanders Bank and visited Imperial in 2024. She has an MPhil in economics from Tinbergen, a bachelor's in economics, and a bachelor's in law from Erasmus University in Rotterdam. She's also been a great participant in our forum and a part of our PhD committee, so we're very happy to have her presenting today. Just for a bit of administration before I turn it over, we'll have messages in the chat reminding you when to join us. Also, please add to the chat or to the Q&A questions you have. If they're good clarification questions I'll try and get them during the webinar. Otherwise, we'll move most of those to the end. So please, questions, participation, we're happy to have. And then I will turn the time over to you, Yasmine, to go ahead and present.
Thank you so much, Mike, for this very kind introduction. It's a pleasure to be able to present my work here in this webinar series after also having participated numerous times as PhD committee member. So the work I'm presenting today is titled Funding the Fittest. It's about the pricing of climate transition risk in the corporate bond market. And this is joint work with Martijn Boermans and Maurice Bung, who are both at the Dutch Central Bank. So that means that the disclaimer applies. Okay, so all of you know that the global productive system must decarbonize in order to meet the temperature target as set out by the Paris Agreement. But of course, given the lack of policy actions, transition risks are rising. So there's an increasing risk that the climate transition is going to be disorderly, given that current policies and actions are not putting us on the 1.5 degrees or 2.0 degrees warming track. And it means that firms are becoming exposed to regulatory risks due to, for example, sudden shocks in carbon pricing policies, but also technological risks arising from changes that they have to make in their production technologies, and also legal risks, which come from reputation, as we're also seeing that legal action against big polluters or their financiers is increasing. Now, we've seen a focus on sustainable investing and ESG strategies in the recent years. There's been a vast literature on whether climate risk is being priced in various types of financial markets. But more recently, there has been a stream in this literature coming up that is actually warning us that the sustainable investing strategies might be counterproductive because it's shifting away capital from brown towards green firms. And the reason why this may be counterproductive is that brown firms, as a result of a declining capital stream, may become more brown, whereas green firms cannot get much more green. So this is a paper by Hartsmark and Schuh, which really look at the impact elasticity, so the changes in the environmental impact based on a change in the cost of capital, but also the Cohen paper that looks specifically at patenting by firms in the energy sector and shows that these firms, even though they are very brown, are actually key drivers of green innovation. So the question that we would like to ask in this paper is, taking this into account, do we actually see that investors fund the fittest? So what do we mean by that? Well, if we think about the transition, this is of course a process where firms that are currently brown may have to make some efforts in order to, well, clean up their production processes. And this is a process that might take some time, which may require some innovations, some changes in the technologies, of course, also the adoption of that technology later on, because only then emissions will actually start falling for these firms. So what we want to do here is actually to take somewhat more of a forward-looking perspective on the question of whether climate transition risk is priced by not merely looking at the emissions at the firm level, but also the efforts that they're making to innovate in the green space. Now we're going to take a firm level focus here, and we're going to wonder, or we're going to ask whether the cost of capital is going to be affected by changes at the firm level in their emissions, but then also the forward-looking efforts that they're making to innovate in the green space and therefore to switch to more greener technologies. Now, we're also going to ask the question which investors actually drive the pricing of climate transition risk, and specifically which investors have a higher demand for bonds of firms that are emission intensive, but yet innovate to a large extent in the green space. Now, I've already mentioned bonds, so we're going to focus on the corporate bond market. So we think that this market is relevant for a number of reasons. First of all, in the US, of course, the corporate bond market provides the marginal source of financing for many firms. Even though in Europe, financing is much more bank-based, the largest firms, so also the most emission-intensive firms, also still rely to a very large extent on bond financing. So we think that this is an important capital market that we should take into account when we want to look at whether investors are pricing climate transition risk. And the second reason of why we think that the corporate bond market is relevant is because, unlike in stock markets, where investors benefit from upside potential, given that equity forms a residual claim in the company, corporate bond investors actually will care much more about downside risks, given that in the end they just want their investment back or their money back from the firms. And given that climate risk and environmental risk fundamentally are downside risks, we think also that this should have more important implications for bond investors or capital markets more generally. So what we're going to do is that we're going to estimate yields regressions here to first look at the pricing implications of emissions as well as green innovation efforts based on the emissions of a firm. And we're also going to do a demand estimation to look more into the second question and to study which investors actually here have a higher demand for brown yet innovative or green innovative firms. So we're going to do this by combining data on global carbon emissions from Trucost, as well as green patent data from Orbis, with confidential bond holdings data from all European Union countries, which I obtained through the central bank. Now, our findings then are as follows. So we're going to show that a change in the emissions of the firm, so an upwards increase in their emission intensity, is going to increase also the cost of capital. So we're going to find a carbon premium here in the euro area corporate bond market. But importantly, we find that this carbon premium is significantly lower for firms that actually make the efforts to innovate in the green space. So more in particular, this tells us that investors actually reward the efforts to mitigate climate change going forward, and it are particularly the highest emitters for which these efforts are being rewarded by investors. And it's approximately a 15% reduction in the carbon premium that we find for these emission-intensive green innovators. Now, we're going to show that institutional investors, and particularly mutual funds, have a higher demand for bonds of emission-intensive green innovators. We also show in our yield pricing regressions that these investors also influence yield spreads related to climate transition risk. So in other words, the effects that we're finding are going to become more pronounced as mutual funds hold a larger share of the bonds of a given firm. And what is also important is that given that it are here the mutual funds that are driving our pricing effects, a question of course arises from what this higher demand then exactly reflects, given that we have seen a big rise in the number of mutual funds in Europe, but also worldwide, and particularly of those that are green mutual funds or ESG labeled funds. So what we want to do also is we want to assess whether this pricing is actually driven by preferences or whether it is actually risk pricing that we're picking up here. And our evidence is going to suggest that it's actually risk pricing that is influencing yield spreads related to climate risk. Okay, so the related literature, we contribute to a large literature on the pricing of climate transition risk in financial markets. There's been numerous papers that look at the pricing of transition risk in the stock market. There's also a couple that look at bank credit and a few that look into the corporate bond market. So given that there are some papers on the corporate bond market already, this is not our main contribution. So what our main contribution is that we really want to take into account here not only the effects of being brown today or being emission intensive today, but also want to take into account the forward looking effects that firms are making to transition to greener technologies. And the second contribution is also that we here want to identify which investors are actually driving climate risk pricing by having a higher demand for bonds of green innovators. Now, second, we also contribute to the literature on green innovation and financial performance. There's a paper from Stefano Battistone and others, and Leipold and Yu, that look more at the effect of green innovation on stock prices, where they show that in the long run, green innovators actually tend to have higher stock prices. But what we show here in this paper is that investors in the corporate bond market, so again, the corporate bond perspective that we're taking here, really asymmetrically reward green innovation efforts. So it's particularly the green innovation efforts of emission intensive firms that these investors are valuing to a larger extent. Okay, so yes, so for the rest of this talk, I'm going to first guide you through the data that we're using, and then the methodology and the results. There's going to be different layers in that, as I will be talking first about just pricing implications, the demand estimation, and then the risk versus preferences analysis, and then I will conclude. Okay, so our data on aggregate security level portfolios is from the security holding statistics. And this data set basically contains all security holdings from financial and non-financial investors from all European Union countries. Now, data is reported at the quarterly frequency and the security by security level. And we're going to focus here for the first part of the analysis on the corporate bond holdings of these investors. So what's important to understand of this data set is that it contains three dimensions in the sense that we have the issuer of the bonds, we have the characteristics of these issuers, we have the characteristics of the specific bond that they're issuing over time, but we also know who is holding the bond at the investor country and sector level. So for example, it can be the case that a specific bond is being held in a given quarter by a pension fund from Germany. Then it can trade to another investor, for example, a mutual fund in France during or in the same quarter or in the next quarter. And these are all transactions that we can actually then trace back in our data. So we know within a given quarter and over the different quarters who at the investor country and sector level is holding the bond. Now, the magnitude of our holdings is rising from the start of our sample period from 1 trillion euros to approximately 1.5 trillion euros, which approximately represents 58% of all security holdings of euro area investors into listed non-financial corporations. Now, the security holding sector's data is augmented with the issuer and bond characteristics at the security level. This is already merged into the data by the central bank, so you get the data of the SHS and the CSDB combined right away. And some of the characteristics that we obtain here are the yield to maturity, also the outstanding bond amount, the type of the coupon, the currency, the residual maturity, etc. And importantly, we also obtain information on the bond ratings, which are directly reported by the three big rating providers to the ECB. Now we're going to determine yield spread. So that's the yield to maturity in excess of the maturity matched risk-free rate. We'll look here at the Eurozone. We'll look here at the Eurozone spot rate, and for bonds which are denominated in US dollars, we'll look at treasury rates. Now, we also have information on the ESG labels of given bonds. So given that there's been a rise also in the green bond market, it's important to know here whether the bonds that we have within our sample are just conventional bonds or whether these are green bonds. And in order to ensure that it's not the greenium that we're picking up here, so the yield discount associated with being a green bond, we're also going to take into account whether a given bond within our sample is a green bond or not. It's approximately 2% of the bonds that are green bonds, so it's actually a very low amount, and it's 9% of companies that also issue green bonds. Now we obtain corporate fundamentals and additional bond characteristics through Refinitiv. We're particularly going to look at all kinds of balance sheet and income statement items from the firm in order to build a set of control variables. And for the additional bond characteristics, we'll mainly also look at the daily bid and ask prices in order to determine the bid-ask spread and also take into account the liquidity of the bond. Okay. So data on the greenhouse gas emissions from firms comes from Trucost, and Trucost provides data on carbon emissions and other greenhouse gas emissions of firms. Data is reported annually, but with a publication lag, so we will be lagging our emission variable. And the coverage is global, and it increases vastly after the Paris Agreement. This is something which is documented in the Bolton and Kasperczyk paper, which shows you a very big hump after the Paris Agreement in the coverage within the Trucost data. So in order to prevent this big jump in sample size, we're actually going to start our sample in 2016, so just after the Paris Agreement. And we're going to distinguish between scope 1, 2, and 3 emissions as is common. And we're going to focus mainly on the scope 1 and 2 emissions for our emission variable. We think scope 1 and 2 emissions, which are the direct emissions from burning fossil fuels yourself, as well as the indirect emissions from purchasing electricity and gas from utility providers, are the most important sources, but also the most reliable sources when or within the emission data, given that scope 3 emissions are or capture all the emissions along the value chains, both the upstream and downstream emissions. There's, of course, lots of issues with measuring those emissions, also methodological complexities on how they may be imputed by data providers. So those will leave out of, of the analysis. Now, we're going to focus on the emissions relative to the size of the firm. And we think that this is an important measure, particularly when considering, given our focus on the corporate bond market, because this measure will tell us the extent to which a firm might be able to absorb any regulatory cost coming from carbon pricing based on the revenues that the firm actually has. So essentially what this measure tells you is if the carbon price will go up, how much will that weigh on the revenues or the sales that the firm is making? And therefore we think that this is a more relevant measure in the given the corporate bond perspective here, because it will really tell investors, or it will inform investors much more about the ability of the firm to absorb these costs financially. Now, we're also going to look at absolute emission levels just to verify that there's no, that there's no differences here coming from how we're explicitly defining our emission measure. But we think that the emission intensity for our purpose, for the focusing on the corporate bond market, is the right measure to take into account. Okay, so we're augmenting our data with information on patents. We're going to focus on patents, given that patents are a very widely used measure of innovation. And we think also that patent data can tell us something about the extent to which firms are actively making efforts to shift to greener technologies or to innovate in a way that also allows them to make that shift to greener technologies going forward. Now, we use Orbis intellectual property for information on general patents, but also green patents of the firms, and we're going to focus on patents filed globally. Now, we identify patent filings for approximately 1,175 unique companies, which are approximately 85% of the intersection of the firms that are in the SHS data and that are in the true cost sample. And in order to determine which of these firms also have green patents, we're going to follow the OECD paper by Hachik and Migoto that looks particularly at the YO2 class. So patents have a classification, and under the CPC classification system, the YO2 class has been labeled the class of technologies related to climate change adaptation and mitigation. And we're going to look at this class as a whole first, but we're also going to assess the robustness when looking at a stricter definition of green patents that are particularly related to the reduction of greenhouse gas emission technologies. Now, green patents only constitute a very small fraction of the overall amount of patent filings. It's around 1 or 2% of overall patents that are green patents. And more interestingly, it's about 1/3 of the unique firms that have at least one green patent. Now, that seems rather little, but what is actually very important is that these 360 companies are a key driver of innovation much more generally, not just green innovation, given that they are jointly responsible for more than 90% of all patent filings. So that really tells you something about the extent to which firms that innovate in the green space also are drivers of innovation, or at least patenting activities more generally. Now, patents can have multiple owners, so we're going to assign patents to each of their respective owners. And in order to determine the point in time for which we're going to take into account the patents for the firm in our analysis, we're going to use the priority date, which is the first date that a patent family has been filed. And importantly, it's also the date after which legal rights can be from which you can obtain legal rights from the patent after it has been granted. Now, given the fact that firms that innovate in the green space also have a very large amount of general patents, and there's of course also some variation in sectors or in given industries with regards to the extent that patenting is common, we're going to take into account a relative measure of patenting or of green patenting. So we're going to measure the amount of green patents that a firm owns relative to the overall amount that of patents that a firm has within the remainder of our analysis. Okay, so we're first going to look at the pricing of emission intensity and green innovation. Then we're going to do the demand estimation, and we'll end with the analysis of risk versus preferences to determine the channel that is behind our pricing results. So let me first actually give you a bit of a primer, and what I'm showing you here is just data. So it's raw data, and what we're plotting here is the mean difference in observed bond yield spreads for firms in the upper quintile of the emission intensity distribution minus the bond yield spread for firms in the lowest quintile or the first quintile of the emission intensity distribution. And what you're seeing here in the data is, of course, that if we take the difference between the yield spreads or the risk, the difference between the yield spreads between high and low emission intensive firms is that this is positive. So this suggests that there might be a carbon premium here. But what is important is that we're seeing actually that this yield spread differential becomes much lower when we're focusing on firms that have an above median patent ratio. So the left bar here shows you the yield spread differential for firms with a below median patent ratio, and the right bar shows it to you for firms with an above median green patent ratio. And this is really what we're after. So to see whether this yield spread differential related to the emission intensity of the firm or their exposure to transition risk becomes lower when firms actually innovate in the green space. Now, this is just raw data, so there might be a lot going on here. So what is now important is to actually look at this relationship parametrically to really get into the effects that is jointly caused by the emissions of the firm or the extent to which they're currently brown and their green patent ratio. So the efforts that they're making to switch to greener technologies going forward. So to first assess whether investors reward green innovation by brown firms, what we're going to do is that we'll estimate the following regression specification. So we'll look at the yield spread, and we regress this on the emission intensity of the firm, the green patent ratio, as well as their joint interaction. And we're going to control for a couple of corporate fundamentals. We'll also look more into ratings, liquidity, and maturity, and other which are fundamental drivers, of course, of bond yield spreads. We also specifically take into account the outstanding amount, the currency, and the coupon of the bond, as well as whether the bond is a green bond or not. So I see that there's a typo here on this. No, sorry, there's no typo on the slide. So we're going to estimate this regression with firm fixed effects as well as with industry time fixed effects in order to account for any unobserved firm characteristics that may be affecting here yield spreads. And we also want to take into account industry specific shocks over time that may, of course, also affect the extent to which emissions at the industry level matter here for yield spreads. Now, we also include analytical weights based on the total amount of bonds that a firm has outstanding in a given period. And we do this to prevent our estimates to be biased towards the largest firms that also issue the most bonds within our sample. But we'll also show that the results are rather similar if we do not include these analytical weights. And standard errors are clustered at the industry level. Okay, so the main result of our paper is then that we find that investors price climate transition risk, and particularly we see that there is a positive effect of emission intensities on bond yield spreads, indicating that as the firm has a higher emission intensity, so when it becomes relatively more brown, it will be reflected by a higher yield spread differential that they will be paying on their corporate bonds. So this yield spread differential is going to amount approximately to 25 basis points. So for a standard deviation increasing emission intensity, and this estimate actually aligns quite well with the estimate of the In Search of the True Greenium paper from Skilden, Lasse Pedersen, and co-authors. Now, importantly, what we're after here in this paper is more the joint effect of emission intensity and green innovation. And what we're seeing here in column 4 and 5 is that the joint effect of emission intensity and green patenting is negatively priced. So in other words, for a firm with a given emission intensity, an increase in the green patent ratio is going to lower its yield spread. Now, we see also, of course, that the green patent ratio itself here has a significant coefficient that one only appears. However, once we include the interaction, we don't find that it's priced on its own. But importantly, here still the combined effect of green patenting and emission intensity is negative. So in other words, for a firm with an average emission intensity, bond yield spreads are going to be on average 3.7 basis points lower for a standard deviation increase within their green patent ratio. Now, this appears rather small, but it will actually have, of course, a large impact when we take into account the amount that a firm has outstanding for a given bond in a given quarter. The outstanding amount is approximately 168 million in our sample. So that means here that the cost of capital impact on average amounts to approximately 110,000 euros annually per bond. And this importantly also is a 15% reduction in the carbon premium here that comes from the joint effect of emission intensity and green innovation. Now, of course, we want to make sure that this result is robust and that there's no other factor driving the effect that we're picking up here from the green innovation activity from the firm. So what we're first going to do is that we're going to assess whether this result survives a couple of other specifications where we're looking at different ways in which we can classify green innovation. So what we show is that when we look at a stricter green patenting definition, is that our results remain relatively similar. The combined effect of green patenting and emission intensity actually becomes somewhat larger, but it actually becomes a couple of factors larger when we look at blockbuster patents. Now, blockbuster patents are patents that are in the top 95th percentile of citations in their given subclass, so in the CPC classification. And there are approximately 5% of green patents within our sample that are blockbuster patents. And these patents, which we can really see as technological breakthroughs, given the amount of citations they have been receiving by other patents, also leads, of course, to a much larger effect here on yield spreads. Now, this is also something that we see when we look at the citations ratio, so the number of times that a green patent has been cited relative to the overall patent portfolio more generally. But we think here that it's important to actually look particularly at the blockbuster class rather than citations itself, given that citations are very heavily skewed, but also given that they're just, of course, captured at one specific time horizon. Now, we finally also just look at the change in the number of green patents relative to the overall amount of patents that a firm has within its portfolio. And there we also find here a significant negative effect, indicating that it's not just the overall engagement within green innovation activity that matters, but also the incremental addition of a green patent. Now, we have a couple of robustness tests where we're going to look also at other drivers of innovation and R&D and patenting activities more generally. But what's important here is that as we're talking about bond yield spreads, is to take into account the effect of credit ratings as well as the liquidity and the maturity of the bond. We find actually very limited effects here of credit ratings, given that it is within firm variation that we're exploring here. So that makes us confident that it's not just a joint hypothesis that we're testing here. So it's not some differential effect of credit ratings on bond yield spreads through environmental performance that we're picking up here. So the effect of emission intensity and green innovation remains stable once we're controlling for credit ratings as well as all their interactions with our variables of environmental performance. Now, the same holds true when we're looking at the liquidity and the maturity of the bond. We find some weak evidence that the effect actually becomes somewhat less pronounced when the maturity of the bond increases, but this actually disappears when we look at the effect of ratings, liquidity, and maturity all at once together. At the same time, though, the effect of emission intensity and green patenting here survives and remains also somewhat in line with our previous estimates, which makes us confident that it's not just other drivers of bond yield spreads that are here behind the effect that we're capturing. Now, we're doing a series of robustness tests in order to ensure that our results are not driven by a disproportional rise in bond supply of emission-intensive firms, in order to ensure that it's not, for example, banks that are denying loans to brown firms and that these firms issue bonds in response. So that's not what we're picking up here. We also assess that it's not the CSPP, so the Corporate Sector Purchase Program of the ECB, that is driving the effects here, given that this, of course, has influenced to a large extent the euro area corporate bond market over our sample period. And we also rule out that it's just investment, R&D, or patenting in general that is driving our results. Now, I've showed you already a couple of alternative specifications in ways in which we capture the green patent ratio, but we also run a series of robustness tests using alternative yield spreads measures, particularly also looking at expected yields, so the yield to maturity minus the probability of default and the loss given default. We also exclude utility sector firms in our analysis to ensure that these firms, given that they're very emission intensive but also innovate a lot, are not driving our results. We also run a robustness test where we use absolute emissions rather than emission intensities, and one where we include all firms that patent more generally rather than only the firms with a green patent ratio higher than 0 in our analysis. So rather than showing you these robustness tests one by one, what I would like to get with you towards is the demand estimation here. So what we're really after here is which investors are really having a higher demand for bonds of emission-intensive firms that innovate in the green space, in order to rationalize here this negative coefficient that we're finding here in our pricing regressions. Now, what we're going to do is that we're going to do a demand estimation. We're going to do a demand estimation a la Khwaja and Miang in the AER of 2006, but then within the corporate bonds space. So that follows a recent paper from Acharya et al. In the JFE. So what we're going to do here is that on the left-hand side, we're going to look at the holdings of a given investor in a specific firm over time. So we're measuring the total holdings at the investor country sector level, and we're going to regress this on the emission intensity, the green patent ratio of the firms. We'll also include an indicator for the investor type, and then we'll look at the triple interaction of emission intensity, the green patent ratio, and the investor type to see whether for a given investor type, we're seeing here that their holdings are higher for bonds of emission intensive firms that innovate in the green space. Now we're going to control for the outstanding amount at the firm level. And importantly, we're going to estimate this specification with firm time and holder area sector time fixed effects. So this captures all potential sources of variation at the firm level over time that may influence the portfolio choice of the investors, as well as investor sector and country specific shocks that may also require them to alter their portfolios. Okay, so the results of our demand estimation are then as follows. And what we're seeing here is that institutional investors have a higher demand for bonds of emission intensive firms that innovate in the green space. Institutional investors here for us are mutual funds, pension funds, insurance companies, as well as other monetary and financial institutions, and we'll look at banks separately. So those are not part of our institutional investors measure. We're seeing, however, also that there's somewhat of a higher demand here for bonds of emission intensive firms by banks. But importantly, when we look at our pricing regressions and take into account the share of the bond that is held by different investor types, we'll see that it are the institutional investors rather than the banks that here really, whose holdings here are associated with this yield discount related to emission intensity and green innovation. Now, demand for bonds of emission intensive firms, which are also green innovators, is approximately 2% higher for institutional investors. And their demand is fully driven by mutual funds when we break up here the institutional investors and look at the specific ones that we're considering. So mutual funds approximately account for or have approximately a 1% higher demand for bonds of these brown yet green innovators. And it is also this investor sector, so the mutual funds that whose holdings are associated with this yield spread reduction related to green innovation. Now, to get to the final part of our analysis, I already alluded to the points that we have seen over the past couple of years a rise in the number of green funds or ESG funds in the Eurozone. And importantly here, what has been documented by Morningstar is that there has been a tremendous rise in the amount of sustainable fund launches, as well as the assets that they have under management. So this then, of course, begs the question whether the higher demand that we're picking up here is driven by green mutual funds and therefore reflects a preference of the investors for these green innovators or bonds of these green innovators. Now, unfortunately, the SHS data does not allow us to determine which investor type here is, or which specific investor or which specific mutual fund is holding the bond, given that we only observe the holdings at the investor sector level. So we know that it are mutual funds that have a higher demand for bonds of emission-intensive green innovators, but we do not know whether these are green funds or just regular mutual funds. But now to get a little bit more at whether it is then risk pricing or whether it's or that it's rather a preference that we're picking up here, what we're going to do is that we're going to look at the firm's exposure to aggregate climate risk, and we're going to assess then whether our main effect is stronger for firms that have a larger exposure to climate risk. Now, in order to do this, we're going to draw on the stock holdings data of the SHS. So I've mentioned to you that SHS contains information on all portfolio holdings of investors in the Eurozone. But importantly, we know not only their bond holdings, but also their stock holdings. Now, this data, of course, becomes particularly relevant given that CRISP does not allow you to look at stock returns from European firms. And a large part of our sample is, of course, or consists, of course, of European firms. So this is a very important data set for us to actually here look at the stock holdings and the stock returns of these firms. So what we're going to do is that in the stock holdings data from the SHS, we're going to look at the monthly stock returns of the firms that we also have within our corporate bond sample. And we're going to assess first within the panel dimension whether stock returns respond to climate transition risk or climate risk. Now, to proxy for climate risk, we're going to use the climate change news index of the Engel et al. Paper in the RFS. And this provides us a measure of aggregate climate risk once we look into the innovations of this climate change news index. So specifically, this climate change news index measures the number of times that climate change is measured or is mentioned negatively in the Wall Street Journal, minus the number of times on which it is mentioned in a positive way in a given article on a given day. Now, if you estimate then an AR1 over these over this index on the daily basis, you'll get the innovations in the index, and these really capture the unexplained part or the unexpected change in the reporting of climate news. Now, importantly, under, of course, the implicit assumption that climate risk, or that when climate risk is higher, there will also be it will also be covered more in the newspapers. You can view then the innovations here in the climate change news index as a proxy for climate risk or aggregate climate risk. Now, what we're going to do is that we're going to regress then at the firm level their stock returns with 12-month rolling windows on these innovations in the climate change news index. And we're going to also include a factor of corporate controls, which follows basically the controls used in the Bolton and Kasperczak paper. And we're also including industry and year quarter fixed effects. Now, what I'm showing you here first in the left column is the effect on average of a change of a change in climate risk on stock returns. And what you see here is that this effect is positive and statistically significant. So that tells you that within a given industry, on average, stock returns of firms are higher when climate risk is high. So that makes sense because it will tell you that investors want to be compensated more for the additional risk that they're taking here. And that varies here also positively with these innovations in climate news. So this first column we see here actually as a sanity check to really assess first whether the measure that we're using is actually relevant. Now, what we do then is that we estimate at the firm level the sensitivity of their stock returns to the innovations in the index, which we refer to as our climate beta. And these climate betas we capture, we save them from our stock data set, and we bring them into our bond data set in order to now take into account the exposure of aggregate climate risk of a given firm. And what we want to see here is now whether the carbon premium becomes higher when a firm has a higher exposure to climate transition risk, and whether accordingly we also find that the joint effect of emissions and green patenting becomes stronger when a firm has a higher climate transition risk exposure. And this is also something that we find. So what we see here in this table is indeed that the interaction of emissions and the climate beta loads positively and significantly, indicating that indeed we're seeing here that the extent to which climate transition risk is priced becomes more pronounced as a firm has a higher aggregate climate risk exposure. And the combined effect here with green innovation also becomes lower as the firm has a higher transition risk exposure. So we view this as some suggestive evidence that it's here really risk pricing that is driving the pricing results rather than an investor preference that we're picking up here. So to conclude, what we're doing in this paper is that we take into account the dynamics of the transition by not only focusing on the extent to which firms are currently brown, but also to capture the extent to which they're innovating in the green space and therefore are making an effort to shift towards greener technologies. Now we assess whether corporate bond investors value these green innovation efforts in the presence of climate transition risk, and which investors do so. Now, as I showed you, investors reward the green innovation efforts of firms that are currently the highest emitters, and this essentially reduces their carbon premium in an extent that is both statistically but also economically significant. Now, institutional investors and particularly mutual funds have a higher demand for bonds of emission-intensive firms that innovate in the green space. And our evidence suggests that it's really risk pricing that we're picking up here. Now, that then also makes sense of why we're finding here that it are really the mutual funds that are driving here the pricing of climate transition risk, and therefore also have a differential demand for bonds based on their environmental profiles, given that these investors are also from our institutional investors, the ones with the greatest risk-bearing capacity. So the way in which we interpret our findings is then that investors, and particularly those with risk-bearing capacity, play an important role here to reallocate capital, not just from brown firms to green firms, but from brown firms to those brown firms that are actually making an effort to transition to greener technologies.
Thank you very much, Yasmine. Really interesting presentation. Appreciate that. I'm going to open it up now to everyone. So if you have any questions and you'd like me to read a question, please put it in the Q&A or in the chat. We'll get those read out, and as well as if we have any of our PhD committee or other sort of moderators participating, I'd be happy to have you read directly as well if you'd like. I will probably start out with a couple of questions if that's all right.
Of course.
So one of the things that I wanted to ask in particular, so everything you're sort of doing here is, unless I missed something, is sort of driven by like European outcomes, right? This is largely focused on European corporate bonds. There's clearly a distinction in terms of political landscape and financial markets structure and across different countries. Like, how do you view this as maybe an upper bound or a lower bound, or how do we sort of interpret this for different regions, whether it's the US or Asia or South America, in terms of how they're incorporating that type of risk?
Right. So I think that's an important question. So what is important, I think, an important nuance here is that the data that we have contains the security level holdings of European investors, but they can, of course, also hold bonds or stocks of firms that are located in other countries or jurisdictions. So I think it's approximately 40% of our firms that are located in Europe. It's around 28 that are located in the US, and the rest is located elsewhere. So in that regard, it is actually a global sample. It's, of course, mainly focused on Europe. What I think, however, actually, initially we thought indeed that European investors, which are, well, then the only ones that we can pick up here in our demand estimation, might indeed have a different demand or a differential demand compared to, for example, investors in the US, just because of differences within the regulatory landscape. There's a recent paper, however, by Dirk Jenter, which is a survey across different investors globally, which actually seems to point out that the answers that these investors are giving, and also the ways in which they construct their portfolios, is actually not that different across distinct geographies. So this is, of course, something that we cannot specifically assess here within our paper, given that we just capture the holdings of European investors. But I think their paper does seem to suggest that there is more of a generalization that can be made than one would think actually at first, or at least it did actually surprise me, because we also indeed first viewed this result as a result that was being driven by European investors. But I think based on the findings from the survey that they have conducted in their paper, I think they might actually be much more generalizable.
Yeah, I'd missed that point that they can hold globally these bonds, but it's the European investors. That's actually have you split up the sample? Do you have enough sort of depth in the data to be able to split across like the types of like the location of holdings?
Yeah, so that's something that we have tried to do now. Indeed, we've mainly looked at firms that are located in the US versus those that are located in Europe. But so far, we have not been able to find an interesting level of heterogeneity actually there. Yeah.
So maybe I can ask another related question. So there's been like a handful of these papers that you've mentioned, the Cohen et al. And the Bolton and Kaprzyk papers that are using this patent data, which I think is really interesting. Sort of as I think about the mechanism more broadly in your result, right? You could think about this patent recognition in terms of ratios of green to total as being sort of a complex task, something that might be done by like, sophisticated investors. So I'm wondering if you think that is sort of what's driving the mutual funds being the main player in this. Do you think there's some other mechanism going on, that this is just kind of a signal and maybe they're not picking that up? I mean, I think that result actually makes a lot of sense to me, that you've got mutual funds picking up a complex risk and highlighting that. But I just want to sort of what do you think is driving this? Is it really that they're picking up that much detail and we're seeing it through mutual funds, or how should we interpret that signal?
So that's a very good question. So it's indeed also interesting to think here really more about the mechanism. So when it comes to green innovation activity, I think, well, it's of course hard to say whether investors are actually, counting the number of patents that firms have. What I think is an important contribution actually that the paper of Leipold and you make is that they seem to pick up from textual analysis from earnings call reports that firms actually during these earnings calls actually mention that they have innovated and that they have obtained a new patent. So apparently this is something that they do talk about during these earning calls. I think actually the point that you make, that it indeed is a more sophisticated type of risk that also aligns well with the finding that it's the mutual funds that are picking it up here, or that are driving the effects. But it would be much more interesting to dive a bit more into that, to find maybe a better explanation for why or how it is that they are actually taking this into account. Yeah.
Yeah, I'm sure a tough question given the data restrictions and limitations that you'll have, but I think it has, I mean, an interesting policy sort of implication to understand that feature if at all possible. I guess I'll ask you one more question. I'll bug on this. So when I think about these types of climate risk, I often think about the dynamic implications that are going on here, right? And one way you could think about capturing that, sort of done in the literature, is looking at how these effects are changing over time. There's some restrictions based on true cost data about how far back you can go. I think the other thing about bonds, and I'm not sure, maybe you've looked at this, is because you're using yield spreads, you could look at spreads over different horizons. right? And you could think about how sort of shorter yield spreads versus longer yield spreads might have differential impacts based on the horizons that you look for that spread. Have you guys looked at that at all, or do you have any evidence in terms of what's going on over time, sort of the dynamic or time series implications here?
Yeah, so actually that's interesting that you asked that. We do, if I can go back a little bit to then go forward, we did make a dynamic plot of the interaction effect that we're finding over time, but it's actually it's rather stable. So there doesn't appear to be much changes that are occurring here. So 2016 is here the reference period, so you can view this indeed as an effect that comes into play after the Paris Agreement potentially. Of course, the horizon is still very limited, so maybe by extending the sample, we'll be able to see much more how this dynamic is evolving over time. So regarding yeah, well, the yield spreads over different horizons, what we have done so far is to just look at differences in the residual maturity of the bonds to see whether this is more an effect that we're finding for bonds that yeah, that will which will have to be rolled over sooner rather than later, or for those that have longer residual maturity remaining. There we do not really find any effects so far yet. It appears, yeah, we found like a, I think I showed it, a weekly significant effect there of maturity, but it disappears once we control for both liquidity, maturity, and ratings at the same time. So far, actually, that's something that we found a little bit of a pity that we do not really find some interesting effects here yet over time or based on the maturity of the bond. Yeah.
Yeah, it is a bit of a tough question, right? You've got again some of these very dynamic implications coming from the political landscape where, things could change drastically. So
Exactly.
I think it's an interesting question, but perhaps a difficult one to really get your hands around. But something that would be interesting to see if it does come up as you extend the sample or look at this in the future.
Yeah. Maybe it won't
Um,
have an effect.
So we have time for maybe one more question. I don't know if anyone else has anything on the chat that they'd like to add or in the Q&A. Um, I was going to ask. So I'll ask one last question as I have a minute real quick. So there is a lot of this data, and you've looked at variation in this in terms of the emissions data. You think about the intensities, the lags, the different measures of this. Um, have you considered or looked at other measures of sort of how to measure this greenness or dirtiness? I mean, outside of the patents, but like sort of characterizing this in terms of the emissions. I think it's a great direct measure. And then we have to think about, how are there alternatives to represent that? Have you guys had any opportunity to explore sort of alternatives on that and see how that might matter?
So you mean really alternatives to the emissions, right? Not the
Yeah,
innovation. Yeah, so far we've mainly looked at alternatives to the innovation
sure. Okay.
by looking at R&D, investments generally, etc. We've not really looked at differences yet for the emissions. I think it's also not so straightforward, given that I think we keep seeing papers which point out that different measures of green or brown is actually do not or well may have negative correlations with each other.
Mhm.
We think in the beginning we tried to look a little bit also at ESG scores, but we didn't have a very high coverage there for our sample at the time, so we didn't continue with that, but it would be interesting to look a little bit more at that. I think one alternative would be to split the sample just based on industry, so the high emitting industries, the low emitting industries. But also there will still within the given industry be quite some variation that you would then actually miss. So I think it's an important question to get also alternative measures here, or even a better measure to really say something meaningful about the environmental profile of the firm. But we haven't done so yet. Yeah.
Okay. Well, thank you so much. We are actually out of time at this point, so thank you for everyone who's come to the webinar and been a participant here. Thank you so much, Yasmine. Again, very interesting paper, wonderful project. Excited to hear more about this as it continues to develop. I'll just give a reminder that our next webinar is going to take place May 19th, and we'll be announcing the speaker and title of that next Monday. And everyone who's subscribed to the eAccess forum will get an announcement for that. We have in the chat window the link to register for future events. Very much appreciate everyone attending, and thanks again, Yasmine, and we will see you at our next webinar. So thank you so much, everyone.
Thank you so much.